We are live. Welcome to the February 2025 episode of Opportunity Zones Office Hours. I'm Jimmy Atkinson, founder of OpportunityZones.com, and I'm going to be taking your OZ questions live in just a moment. So if you have any questions about Opportunity Zones, you can submit them by using the chat. We're going to talk about the Trump tariffs as well and what impact that they have on Opportunity Zones. But before we begin, are you looking to take your Opportunity Zone strategy to the next level, but maybe you're not sure where to go? Opportunity Zone Insiders offers comprehensive premium content and networking to help you get started. Our monthly masterclass meetings cover a wide range of topics from fundamentals to more advanced topics, ensuring that you have what you need to thrive. And as a member of OZ Insiders, you'll get access to our exclusive online community, monthly group coaching, and monthly masterclasses, providing you with valuable OZ networking opportunities and guidance from the very best OZ professionals in the industry. So whether you're a beginner, maybe you're brand new to Opportunity Zones, or you've been in the industry for a little while and you're looking to get to the next level, we have what you need. Visit ozinsiders.com to learn more. That's ozinsiders.com. Welcome again to the February 2025 edition of Opportunity Zones Office Hours. It is Monday, February 3rd, 2025, and you can join me the first Monday of every month right here at 3 p.m. Eastern Time to get your Opportunity Zones questions answered live. So whatever questions you have about OZs, I'm here to answer them for the next 30 minutes or so. Just type your questions into the chat. But first, I want to talk about the big topic of discussion today that we teased in the email, and it's the thumbnail for today's episode as well, which is the Trump tariffs. So let me get my my screen share up here first of all. There we go. And I wanted to first of all just show you what's happened with the lumber futures, because a lot of the impact that these Trump tariffs are going to have on Opportunity Zones really deals with, well, what kind of impact are they going to have on construction costs? How are they going to impact the cost of construction materials? Mostly electrical and lumber are two of the big ones. So I won't show you futures contracts on every single thing that the Trump tariffs may impact, but let's just take the look at the lumber futures contract just for the last 5 days. 5 days ago, this particular lumber futures contract was hovering around 557 or so, and it spiked up pre-trading this morning, hit 623. Now, just within the last hour or two, the United States and Mexico came to an agreement on the Mexico tariff. So I think they've been suspended for at least a short-term period. I actually haven't read much more than just what I saw on the headlines very quickly. So I only know very high level what's happened there. So we've already seen this price of lumber come down significantly just in today's trading, down near the 590 to 600 level right now. So you can see kind of just how this has grown and been pretty volatile over the last few days here. Here's what it looks like over the last month, over the last 6 months. And you can see quite a lot of volatility here since Trump was elected, essentially. So one of the things that a lot of people are saying, myself included, is that a lot of these tariffs may be more saber rattling by Trump, using these threats of tariffs as a bargaining chip in ongoing negotiations with these different countries. So, whether or not he'll actually go through with them and for how long he'll go through with them, it's kind of unpredictable because Trump is an unpredictable person. It's still kind of TBD. This is all playing out in real time. We've already seen kind of a pullback from the tariffs on Mexico, but still the tariffs on Canada and the tariffs on China, I believe, are still set to go into effect unless something's changed within the last few minutes that I haven't seen. I've also been keeping an eye on, I regularly read these market summaries from Origin Investments. They're one of the largest OZ fund sponsors in the nation, and they point out a couple things, by the way. First of all, that how big of a deal is this on construction anyway? How much material do we actually source from these three countries? Well, quite a bit, actually. According to Origin Investments, approximately 46% of U.S. construction materials are sourced from these three countries: Canada, China, and Mexico. and approximately 35 to 50% of total multifamily project construction costs are tied to finished materials such as lumber, appliances, and HVAC equipments. And essentially, they are saying that these tariffs are inherently inflationary, and I agree with them. So, if the United States slaps a 25% tariff on goods from Canada and Mexico, 10% on China. I believe I read elsewhere that it's going to be a 10% tariff on energy imported from Canada. That all goes to somebody's bottom line, right? And it's going to impact how much construction costs. So let's talk about what that means from the point of view of opportunity zones. What does that really mean? Well, the fact of the matter is actually that, and later in this article, it talks about it, new residential construction over this time period of end 2019 through end 2024, we've seen a lot fewer construction starts over the past couple year period than we had in the previous couple year period. Not a huge difference, but there are fewer starts than there were maybe 2 or 3 years ago. So what's happening is these tariffs, if they do turn out to be inflationary, if the United States does go through with them and they are in place for a prolonged period of time, it is going to impact the cost of lumber and other construction materials. That is going to have a big impact on projects that are just beginning construction or are about to begin construction, much more so than projects that are already completing construction, or maybe they're already completed and starting to lease. So what does that mean for the value of each different project? It means the value of deals that are in the planning phases or the early construction phases are going to be a little bit lower than the value of deals that are just coming online. So if you're an OZ investor and you've invested in a fund maybe early on, 2019, 2020, 2021, maybe your fund and the deals within that fund are already maturing and they're leasing up, or they're nearing construction completion. Maybe they're substantially complete already. I'm talking about new construction, by the way. Not so much substantial improvement, but those deals are going to have a lot more value to them. The other thing this is going to do is it might impact how many new starts there are. If construction numbers kind of get out of whack and new construction is less feasible going forward, maybe 2025 just isn't a great time. Maybe the economics start to not make sense to put new construction deals in place in 2025. That could quite be possible. If these tariffs end up having a major inflationary impact on the cost of materials, some developers might just say, hey, we're not developing in 2025. It just doesn't make sense to do so. Well, then you have fewer units going online. So you have less supply, you have constrained supply. The demand is remaining the same, or it's going up more than likely as our population grows. So it's going to increase rents, or it's going to put an upward pressure on rents, which should impact the value positively for existing stock and for stock that's about to come online. So those are my thoughts. If you have any thoughts, I'd love to hear thoughts from you in the audience. Feel free to chime in with any thoughts you have. Did I get it right? Did I get it wrong? Curious to hear what you have to say about that. So let me see. We do have a comment here from Andy, a longtime supporter and listener of the show, and my partner here. So he says, Jimmy, do you think Trump actually intends to implement the tariffs long term, or is he just using them as negotiating leverage? Okay, so kind of getting at the point I was making, I think, Andy, was I don't know. I don't think anybody knows. Truth be told, I don't even know if he knows. I think you can certainly argue either side. Does he really think that, I've heard him go all the way really hard in one direction of we need to get rid of the income tax and go back to just having tariffs, because that's what our nation had in place for treasury revenue for the majority of our nation's history up until about 100 years ago or so, that the income tax came into play. That would probably wipe out opportunity zones. And I don't think he's super serious about doing anything like that. I think it'd be hard to repeal the income tax at at this stage, but who the heck knows? Andy, to answer your question, I don't know. I could see him going either way on this. I think it depends. First of all, he's already had success using tariffs as a negotiating lever just with Mexico, just within the last hour or two. Andy, you also asked, have the OZ sponsors you talked to in January generally been bearish or bullish? Okay, so kind of changing topics here. So let me go back, big screen here. That's a great question, actually. Andy, so let's move on from tariffs unless anybody else wants to chime in with any questions about tariffs. But have OZ sponsors that I've talked to in January been generally bearish or bullish? Everybody that I've talked to since the election has been very bullish on opportunity zones for two reasons. One, just the current political climate in Washington makes it more likely than not that opportunity zones are going to get an extension and possibly be made a permanent part of the tax code. So that's all already very exciting. But then the second point is, I think now that the election is over and there's just certainty about the direction that Washington is going in, I think that certainty and clarity has given investors much more comfort. And anecdotally, the accountants, the attorneys, the fund managers who are raising capital that I have talked to over the past couple of months since the election, past almost 3 months now, actually, have all told me that their phones are ringing a little bit more. They're fielding more questions. They're getting more investor activity. I think investors are ready to get off the sidelines. I don't know if that's a result of just simply the election being over and us turning the calendar to a new year, or perhaps they view Trump as more favorable for the economy and more favorable for business. Either could be the case, or both could be the case. So I to answer your question, Andy, I've seen definitely much more bullish reaction than bearish reaction over the past several weeks. I've got another comment in here from Kirk. Kirk says, do you see support to renew the OC laws that are expiring? Kirk, yeah, I've seen a lot of support, actually. Support nationwide. First of all, so let's kind of break this up into two different parts here. One is opportunity zones, which we're really focused on here. And the other part is a larger piece of the puzzle, which is tax legislation. But let's just talk about OZs right now. So just OZs, opportunity zones enjoy really broad bipartisan support all over the country. There are naysayers, there are detractors, there are members of Congress in Washington who do not like opportunity zones or are against opportunity zones or think that opportunity zones don't work for one reason or another. But by and large, across the country, at the mayoral level, at the gubernatorial level, at the presidential level, all these different levels, developers, mayors, governors of states, they all really like opportunity zones because it's bringing in capital to areas of their jurisdictions that might not otherwise receive it. And that's on both sides of the aisle. Republicans really like the program and Democrats really like the program. So there's a lot of support to renew the OZ statute of the tax code within Congress, because that's really what matters. It doesn't really matter what the mayor thinks or what the governor thinks. It really matters, what does Congress do, right? Within Congress, there are members of both sides of the aisle that originally supported the program. In fact, when the legislation was first being brought in 2015, 2016, and 2017, before it was finally enacted at the end of 2017, the people putting together this program brought in senators and congressmen 2 by 2, just like Noah's Ark, as my friend Shay Hawkins likes to say. 2 by 2, meaning they always had to have one Democrat and one Republican lined up to co-sponsor. And I think they got about 30 or so members of Congress from both sides of the aisle to come in and champion that program and co-sponsor that small piece of the tax legislation. Now, what ended up happening was in 2017, this huge tax legislation, Trump's Tax Cuts and Jobs Act, it was passed along partisan lines. No Democrats voted for it. Almost every Republican member of Congress voted for it. And that's how OZs and a lot of other Trump tax cuts became law. So a lot of these tax cuts are expiring at the end of this year, 2025. OZs expire at the end of 2026. Republicans are in charge of the House and the Senate, and Trump is in the White House. So the thought is in the industry that the political climate is very favorable to get opportunity zones renewed sometime this year before the program runs out. So I'm hopeful, more likely than not, that we're going to get a renewal of opportunity zones, Kirk. And thanks for the question there. So if you have any questions for me, please do use the chat, whether you're watching us on LinkedIn or on YouTube. Just use the chat to submit any questions that you may have. Let me see if I have any questions in here. One question that I get a lot, actually, from newer folks is, hey, I'm new to Opportunity Zones. I just want to understand, how does this thing work? What are the incentives? How do I take my capital gain and put it into a fund? Or, if I am a project sponsor, how do I raise capital from funds? I have a lot of this information, this material laid out in great detail on my website. I have a guide on my website at opportunityzones.com. And I also have a free beginner's guide that I like to remind people of as often as I can remember to remind them of. It is, please do download my free beginner's guide to Opportunity Zones. It's a great 30-page explainer on exactly how Opportunity Zones work from A to Z. You can download that by heading over to opportunityzones.com/download. So one other question that I got the other day, by the way, and I'll kind of spend a little bit of time talking about this, and I don't have it queued up as a banner here right now, but I'll take this one off the screen. The question I got asked this by a potential new Opportunity Zone project sponsor on an intro call that I did with them earlier this week, was they had questions about, if we're putting together this Opportunity Zone deal and it's going to revitalize this existing building, how much time do we have to get it to completion? What's the 31-month working capital safe harbor business plan? What does that mean? What's the 30-month substantial improvement period? What does that mean? How much time do we actually have once we set everything up? This is a great question to ask, and it does get very technical very quickly. And depending on the facts and circumstances of your particular deal, the dates and the exact timing may change. But I'll try to walk you through just a pretty basic explanation of how all of these different timelines really interact. So first of all, we're talking about an existing asset that you're acquiring, an existing piece of property that you're acquiring that's going to be substantially improved. And before I go to the whiteboard, actually, maybe just a quick note on substantial improvement. There's two different types of real estate deals that you can do as an Opportunity Zone deal. One is new construction, right? So that's easy. You're just building a new building from the dirt that exists, that you acquire land and you just put sticks in the ground, you get a new building, right? That's easy. So let's put that aside for a minute. Let's talk about substantial improvement. So what if you buy an existing asset and you need to substantially improve it? So first of all, in order to substantially improve it, you need to double its value, essentially. And I'll just draw this building on this plot of earth here, put a couple windows in it so you can tell it's a building, maybe a door here. Okay. So first of all, what is this building? Let's say you acquired it for $1 million. Okay. So you need to substantially improve the building, first of all. But what does that mean? How much is the land valued at and how much is the building valued at? That's going to be relevant to know. So let's say you get the property assessed and the land is valued at $200,000 and the building or the improvement on the land is valued at $800,000, right? So in order to meet substantial improvement provision of Opportunity Zones, you need to more than double the value. So you need to put in $800,000 is the amount of work that you need to put back into the building. Okay, so you don't need to put in the full 1 million. You can ignore the land value. for the purposes of substantial improvement. So that's substantial improvement. And what you have is you have a 30-month period to do that, okay? But when does that begin and when does it end? And frankly, when this begins, this is the substantial improvement period. When it begins is kind of the subject, a matter of some debate among some professionals, even within the opportunity zone community, because if you read the regs, it actually says within any 30-month period. Now, if you're determining that literally, that means you can choose kind of when you start it. Now, others have interpreted that to mean the clock starts ticking when you acquire it. But is that the only period of time that you have? Is it just 30 months from the date of acquisition? And it's like, yes and no is the answer to that question. Because the other thing that you can kind of use alongside this 30-month substantial improvement period is the 31-month working capital safe harbor plan. Or I'll just say WCSH, working capital safe harbor. And what you're doing, by the way, when you kind of use both of these is it's buying you time to meet your asset test. So we'll have to talk about the asset test a little bit also. And what is the asset test and when does it go into effect? And what does it mean to pass the asset test? And what does it mean to fail the asset test? And I think what I'll do, actually, I'm going to take a minute to pull this up on my screen right now, is I want to find IRS Form 8996, because that's the form that qualified opportunity funds use to report to the IRS exactly how they are deploying capital into opportunity zones. And I just want to show you how that form looks and what you have to end up doing on that form exactly in order to comply with opportunity zones. So I'll show you. I have to put this on the other monitor here. Here we go. Okay, so here's IRS Form 8996 here. This is the Qualified Opportunity Fund form that each fund has to fill out. I won't go through this line by line. I actually do have a video that I shot with Ashley Tyson a few years ago that walks you through all these. So if you do a Google search on how to file IRS Form 8996, you'll probably see me and Ashley smiling. That's our video on exactly how to fill this out. But essentially, there's a worksheet here where you have to calculate, and here it is right here, the last day of the first 6-month period. And then there's another part here where you can calculate the penalty using, you got to kind of figure out where exactly all of your assets are on each of these months. But essentially, this is really the part that you have to pay attention to right down here is QOZ part 6 right here. You do a 6-month QOZ property test and a year-end QOZ property test, which means really just on the end of the first 6-month period, June 30th, and the end of the year, December 31st, is when you conduct these different asset tests, okay? I'll get rid of the screen now because I don't think we need to see 8996 too much more. We'll just go back to the whiteboard. You conduct these asset tests at these 2 dates every year, with the exception of the first time your fund hits one of these dates is a cure period, and you don't have to hit the asset test. By the way, the asset test measures, have you hit 90%? 90% of a qualified opportunity fund's capital has to be in good assets, has to be deployed into qualified opportunity zone property on each of these dates every year. Again, except for the first time you hit it, you have a cure period. So let's say you set up a fund on today, February 3, 2025, and you drop some money into it. Your first asset test comes on June 30th, 2025. You're allowed to fail that test, okay? You could have 0 in there and it's just fine. So then your second one would come December 31, 2025, okay? That's the first one that you have to pass. But so essentially you have to have the money drop down into a QOZB by that date, and then the QOZB has a separate asset test, but it doesn't report on a form. It just merely has to comply with this on internal docs. And really, you want to keep internal docs just in the case that you get audited at some point down the future. But December 31, 2025 is really the first time you have to pass this 90% asset test at the fund level. But if within the QOZB now, so you drop the money down into a QOZB, right? I'll just delete this for now. Okay. So you have a QOF, okay? And then you drop the money down into the qualified opportunity zone business, okay? As long as you've got 90% of your assets in here by December 31, 2025, in our example, then you're good. Now, within the QOZB, that is when this 31-month working capital safe harbor business plan comes into effect, okay? So the QOZB has to hit a 70% asset test. So at the QOZB level now, 70% asset test. But if you have a 31-month working capital safe harbor plan, you have 31 months where you don't have to hit that 70% test. As long as the working capital safe harbor plan is, first of all, contemporaneously recorded. Again, in case you get audited later down the road, you want to be able to show the IRS that you were adhering to this plan and the plan is sound and it's reasonable. Then it buys you a lot more extra time. Now, I don't want to get down into the nitty-gritty too much more than this because I think I've kind of already sucked up a lot of time with this, but I just wanted to lay this out for you in case you are just starting to raise capital for a plan. You're not sure when exactly you need to deploy it or how you need to deploy it. It's a great topic to get up to speed on, to ask your accountant follow-up questions or to ask your attorney follow-up questions. And I think with that, and then, by the way, essentially the 30-month substantial improvement requirement, once you do acquire land, because oftentimes you'll fund a qualified opportunity fund, and then that fund will fund a qualified opportunity zone business. But that business may take a period of time. That business might take 6 months or a year to acquire a property. Then once you acquire the property, you then have 30 months to substantially improve the property. So if you put all of this together, you don't have to put money into the QOF, put money into the QOZB, acquire a property, and then substantially improve it immediately. Like that doesn't all need to happen within a 1 or 2 or 6 or 12 or even 24-month time frame. It can take years. It should take years, right? And some of these provisions really allow you that extra time in order to do that. So that was a question that I had from a potential new sponsor on an intro call that I did with them just last week. So spoke about that at a kind of a high level, but hopefully that was helpful to anybody. I'm going to go to the comments now because I see we've got some comments in questions right here. So let's see. First of all, I'm going to address this question from Kenny Rosenbach. Thanks for being here, Kenny. Really appreciate seeing you here. It's been a while, but good to hear from you there, Kenny. Could you explain step up in basis? We are 7 years in. So if we were in on day one, when do you actually see that credit? That's a great question. So I'm going to go to the dry erase board again here. And Kenny wants me to explain the step up in basis. I'll just move this board up so we can see the whole thing. So there's three big benefits to opportunity zone investing, right? One is a deferral period. You get to defer your gain until the end of 2026. That's not worth much here in 2025. It's only a 1-year deferral period. A year from now, it won't be worth anything. Essentially, there will be no deferral period. The second benefit was these different basis step ups that you could take based on when you invested into a qualified opportunity fund. If you invested prior to the end of 2019, you could potentially receive a 15% basis step up. And if you invested prior to the end of 2021, you could potentially receive a 10% basis step up. And I'll explain what that means in a minute. The third big benefit is the big enchilada, I like to call it. And it is no capital gains tax liability on the opportunity zone investment after a 10-year holding period. So you hold the OZ investment for 10, 11, 12, 15, 20 years, however long you want, as long as it's 10 plus years. You sell it at a profit, you pay no capital gains tax on that profit. Pretty simple. Let's go to the dry erase board and I'll explain a little bit more about the 10% and 50% basis step up. So first of all, 2019, prior to the end of 2019, you got a 15% basis step up. And prior to the end of 2021, you got a 10% basis step up. After that, 2022 and beyond, zero. So if you invested in a qualified opportunity fund after 2021, this doesn't apply to you. I'm going to put a little asterisk by this, though. So let's come back to that. And here's how it works. And Kenny in his question addresses 7 years. So why 2019? Well, essentially, Congress said you had to be invested in an OZ fund for 7 years prior to the end of 2026, prior to the deferral date of December 31, 2026. To receive the 5% basis step up, you had to achieve a 5-year holding period prior to the end of 2026. And so what does this mean? This means the statute, and I'll actually bring up the statute right now because it's kind of interesting. If you like a little bit of, if you like to read the statute, I like to read the statute. I think it's kind of interesting. So we'll do a Google search for 1400Z-2, and we'll go to special rules for capital gains invested. So deferral of gains. Let's see, where is it here? Determination of basis. Oh, so here's where it explains, what do you owe? What is the amount includable on your tax bill on, I'm going to zoom in here so you guys can see it a little better. The year of inclusion is December 31, 2026. So you have I just realized I'm not sharing the screen here. Let me share the screen. You have let's say you're investing $1 million of gain into an OZ, okay, into a QOF, okay? When do you pay this $1 million gain? Because you get to defer it, right? You get to defer recognition of it until 12/31/26. So you owe money on it on typically like 4/15/27. Tax day of 2027 is when you would owe taxes on it. Okay, you owe taxes on this $1 million gain. That's what this part of the statute is saying. December 31, 2026. But how much do you owe? Well, you owe the amount of gain shall be the excess of the lesser of the amount of gain excluded under paragraph 1 or the fair market value of the investment over the taxpayer's basis in the investment. So when you first come into, it's basically saying, this is kind of, you have to read this like 100 times to really understand it, but it's basically saying the amount of money you owe is going to essentially be this. It's going to be $1 million minus X, and X is your basis in the QOF, okay? So what is your basis in the QOF? Well, when you first invest in a QOF, the IRS has said your basis is 0. So your basis is normally 0, okay? So what's 1 million minus 0? It's $1 million, okay? But what they're saying is, look, if you achieve a 5-year hold prior to the end of 2026, will give you a 10% basis step up. So that means then under that case, what's 10% step up from 1 million? It's 100 grand. Okay, so now you only owe taxes on $900,000 of gain. All right. But what if you achieve a 7-year hold prior to the end of 2026? Well, then we'll step up your basis by 15% of this gain amount. So that's 150 grand. So then the amount of gain that you recognize in 2027 on your 2026 return is only $850,000. Yeah, the statute not worded that great. Took me a long time to realize what the heck they were talking about here when I first reading this in 2018. But that is essentially what it's saying. So Kenny, if you put $1 million, I'm just using $1 million as an example. I don't know how much you put in, but I just like to use $1 million usually. If you put $1 million of gain into a QOF in 2019, let's say, in 2018 or in 2019, you will have achieved a 7-year hold by the end of 2026. So then you get to deduct 15% of your gain amount from the gain that you put into the QOF on the date that you recognize that initial gain. So on your 2026 tax return, instead of recognizing a gain of $1 million, you recognize a gain of $850,000. So it effectively reduces your tax liability by 15%. But I've heard people refer to this erroneously as a step down in basis. It's not a step down in basis. It is a step up in basis, but the step up in basis helps you because it does reduce your tax bill through that language in Internal Revenue Code section 1400Z-2. So I hope that helps clarify it a little bit. Oh, I forgot to address the asterisks. So remember, I said there was an asterisk next to if you invested after 2022 or beyond, you got a 0% basis step up. Well, the asterisk refers to the legislation. So if legislation extends OZs, if there's an extension of opportunity zones, unless they draft some language to the effect that it would not have an impact on these investors, I believe that it would, because what the draft legislation that they introduced, at least in the last session of Congress, said was that they were going to change this date. They were going to change this date from December 31, 2026 to December 31, 28. So what does that do? Well, essentially that means then that in order to achieve a 5-year hold, you need to have invested prior to the end of not 2019, but now 2021. No, excuse me, from 2021 to 2023, right? And if you want to achieve a 7-year hold to get and again, this is for 10%, 7% gets you the 15% basis step up. You need to get by 2021. So remember, this was 19, and now it's 2021, and this was 21, and then it would turn into 2023. So possibly, if you invested in 2022 or 2023, you might end up receiving a basis step up that you weren't previously expecting, which would be a good thing to have, right? So these people would be eligible for a 10% basis step up, reducing their tax liability. So I think that's kind of cool. I don't know exactly what the new legislation might end up looking like. I hope we see some draft legislation within the next couple of months here. But that's one way that the legislation could impact people who have already invested, possibly retroactively impacting them in a positive way. Let's see, Brad Molotsky. Thanks for being here, Brad. He says, Jimmy, thanks for hosting. What are you hearing regarding having ordinary income being eligible for OZ treatment as part of the reconciliation process? Great question, Brad. I want to bring up the Novogradac letter. So let me find that really quick here. To cut to the chase, though, I don't know if I'm going to be able to find this in 1 minute or not. But Brad, I have heard that circulated as a potential change that the OZ industry would love to see. I'd love to see it. I think the big issue, though, is that it would make the program very expensive. So I think, or as they would say in Washington, D.C., it wouldn't score well. It's going to make it look very expensive. So I think politically, it's going to be hard to convince enough members of Congress that it's a good idea. And I did just find the Opportunity Zones Working Group letter. So I'm going to share that on the screen right now. And so this is a letter that the Novogradac Opportunity Zones Working Group drafted to the Trump administration 1 month ago. And it includes numerous suggestions for how to improve and modernize opportunity zones. And they break it into a couple different parts. One of them is to, one of them is to enhance the existing incentive in the near term. And the other one is to renew opportunity zones and make it permanent. And one of the ideas they had on long-term programmatic changes was to, let's see where I can find it here, allowing non-capital gain investment. So they recommend that all taxpayers be able to participate in the OZ incentive by allowing taxpayers with non-capital gain taxable income to defer all or a portion of that income by investing in a QOF. And they also recommend allowing investors to invest after-tax dollars in a QOF. So it'd be both pre-tax, non-gain dollars, and just essentially deferring a portion of income to a future year and being able to take after-tax dollars. So maybe you've had money in savings for who knows how long, taking that, putting it in. So, Brad, it is an idea that's floating around. I think it's going to be, I'm hopeful that it gets included, but I think it's unlikely that it gets included because I just think it's going to make the whole program look too expensive. Anyways, great question, Brad. Thanks for that. Let me read a few. I've got a lot of questions that have just come in here. This one from Eddie is pretty easy, so I'll answer his. May I have the replay of this webinar, or is there a link to access the recorded webinar? So the link to access the recording of this is this link. If you found this is the recording. So if you're watching live right now, use the same link. If you missed the first 5 or 10 or 30 minutes, and go ahead and just use the same link. It'll be at the same place. Let's see. I'm going to maybe get to 1 or 2 more questions because we are coming up on time here. I don't like to go too much longer than 40 or 45 minutes here. We'll see this question here from Kirk. Kirk asks, multifamily is in a challenging place right now. How can OZ deals help these projects to move forward? Is there a better chance of getting investors if a project has OZ benefits? So this is a 2-part question here from Kirk. I'm going to get rid of that Novogradac letter on my screen. So Kirk, multifamily challenging place right now. Not quite sure what you mean by that. I mean, you can mean a couple different things. One, we don't have enough multifamily, right? And 2, it's challenging to get multifamily started right now. Maybe the economics of building new multifamily isn't working out right now because of construction costs, because rents have kind of staled or slowed. Rent growth has slowed. That's what I'm trying to say. And construction debt financing has gone up. Interest rates are starting to creep back up. The 10-year treasuries going back up. There are a lot of challenges with multifamily. I take your point there. How can OZ deals help these projects to move forward? So essentially, to answer your second question, is there a better chance of getting investors if a project has OZ benefits? I think so. And we have in that guide that I referenced earlier, which I'll show on the screen right now, this free beginner's guide to opportunity zones, there is included in that guide a table that shows 2 different deals, all else being equal. One is an OZ deal, one is a non-OZ deal. What is the bottom line to an investor? The after-tax numbers make the OZ deal look like a no-brainer compared to the non-OZ deal. It's really quite powerful, actually. Powerful. What happens if I'm going to see if I can find that right now while I'm talking also, because it's just on our website. If you go to opportunityzones.com/guide, it's broken into a few different sections here. But I think absolutely, Kirk, there's a huge benefit to investors for having it be an OZ deal. If If you have a deal in mind already also, and if it's already in an opportunity zone, there's zero reason to not structure it as an OZ. If you bring in non-OZ capital, that's fine. You might have investors who aren't interested in the OZ for whatever reason. Maybe they don't want to go through the process of filing Form 8997 every year. Maybe that's too burdensome for them, although it really shouldn't be. Maybe they don't have, more likely, maybe they just don't have a gain that they want to defer. So you'll have some investors who might want to come into the project and not take advantage of the OZ incentive, and that's perfectly fine. But if you're looking for new investors, you can absolutely tout it as an OZ deal. And I think that makes it pretty powerful, especially once you show them this page on my website or something similar to this page on my website, which I'm going to display on the screen right now. This is part of that free beginner's guide to opportunity zones, which I've just mentioned a couple of times. Unlimited tax-free growth. You can see here's the table that I was referring to right here. A non-OZ investment, what it shakes out to versus a qualified opportunity fund investment. This is a pretty large difference here, pretty big delta on the back end of both these investments. So one of the $1 million investments grows to nearly $2 million after taxes, and the other one grows to 1.5. Pretty good return either way, but I'd rather have the 1.9 million versus the 1.5 million. This doesn't even take into account depreciation recapture either. There's going to be depreciation recapture on the non-OZ investment, but there won't be on the QOF. I explained that a little bit more detail in Benefit 4 here. So if you want to get access to this guide, head on over to opportunityzones.com/download to learn about that. Let's see. Did I answer your question there, Kirk? I think I did. Yes. So I think short answer, yes, Kirk, I would definitely do that. And hopefully I've spoken enough about that right now. Let's see here. One last question here from Kydex Joe, and then I think I'm going to wrap it up. Joe asks, if we're getting ready to launch a fund in 2025, how can we contact you to understand the coaching program? And how can the coaching program help in the early phase? So I'll address the second part of your question first. How can my coaching program help in the early phase? I think you're referring to OZ Insiders, my mastermind group and group coaching community that we started back at the end of 2023. It can help you in the early phase by really helping you understand how to go from, I have this investment thesis, I have this project, to I have to put a fund around this and raise money for this fund. How do I launch a fund? How do I legally structure a fund? How do I take the fund to marketplace and raise capital from investors? And then once I have a group of investors, how do I close them? And then how do I do ongoing investor relations with them? That's a lot of what we specialize in at OZ Insiders. A lot of what I myself specialize at, but also a lot of the members within my community, the professional accountants and attorneys that I have as members in my community that come and teach the classes and to whom I refer clients out to. I can help connect you with the best securities attorney, with the best OZ structuring attorney, with the best accountants that the industry has. So if that's of interest to you, I would encourage you, check it out, ozinsiders.com. If you have a question for me, maybe send me an email. info@opportunityzones.com is a great way to reach me, and maybe we can schedule a call if you want to discuss it in more detail. But that's all I have for today. Kirk says thank you, Kirk. Thanks everybody for being here today. Really appreciate all the time that you've given me. Thanks for watching. If you enjoyed this episode, by the way, give me a thumbs up if you're watching this on YouTube. That helps other people find our YouTube channel. And please be sure to subscribe to our YouTube channel as well. I'll be back with another episode soon. Join us Mondays at 3 p.m. Eastern time on the opportunityzones.com YouTube channel. Thanks, everybody. Appreciate your time today.